The Dentalpreneur Podcast. Okay, doctor, it's time to put down that handpiece. You're listening to the show dedicated to helping dentists get their lives back. It's time to decrease your stress, increase your profitability, and regain your passion. Now introducing your host, Dr. Mark Costas.
Hello, everyone. Welcome to another episode of the Dentalpreneur Podcast. I'm your host, Dr. Mark Costas. What's up, friends? I hope you're doing awesome out there today. This is a multiple time guest. I love talking to this gentleman about all things transitions, the kind of current situation in the private equity markets and the DSO markets. He's been doing this for a lot of years. Let's welcome back to the podcast, Kyle Francis. He earned his bachelor's degree in entrepreneurship and professional sales from Baylor University and later completed his MBA at the University of Colorado, specializing in finance and strategy. In 2007, he founded Professional Transition Strategies, where he represented sellers in more than 400 dental practice transitions and generated over $2 billion in total deal flow by helping clients explore individual, group, and private equity options aligned with their goals. Kyle, welcome back to the podcast, buddy. How are you?
Hey, it's great to see you, my man.
Sorry about the ski season.
It is so brutal.
It's
I'll tell you
so
what.
bad. I haven't seen it this bad in a decade. It's been terrible.
Yep, completely agree. It's kind of interesting. I think that they say that, so they've been tracking the snowpack since like 1800s, 1880, something like that. And it is literally the worst year on record for the entire snowpack in Colorado. So like, you go back 140 years and this is kind of where we are. So
really,
we got one good weekend in Crested Butte like 2 weekends ago, but that is it. Other than that, it has been junk.
It's been bad. I was in Winter Park about a month ago now, and it was not good. It was not good. A lot of stumps, a lot of grass, a lot of ice. It's still better than not being on the slopes, but man, it was dangerous. I felt like.
Completely agree. Yeah, it rained in the mountains yesterday, so not even snowed. It rained.
That's not good.
So, nope.
That is not good. That's not going to help. That's not going to help matters much. I know you live for skiing. You and your family just love it. So I felt for all of you guys. I usually try to get out 8 or 10 times a year. I got 6 days in this year, and I consider myself lucky for that, but they were not 6 good days.
Right. Yeah, completely agree. So you actually have more than I do at this point. So
really?
I feel like I might be becoming a snow snob, and I'm kind of wondering whether I'm growing 2 little snow snobs as well, because all of us are looking at each other like, I don't know, do we go out this weekend? I don't think so.
Yeah,
you know? So
I get it. I mean, I'm not even close to the level of sophistication that you guys are. So I just get out there and I try to just have fun no matter what. It's kind of like surfing. Like, I don't need perfect waves in order to surf. Like I could have 2 to 3 foot ankle slappers and I'm having fun out there. But once you get to a certain level, you have to have a certain amount of quality, or else it's just either dangerous or it's just not fun for you at a certain level.
Yep. I do agree that the dangerous part of it is real, you know. So there was a buddy of mine, he was skiing this last weekend, and he said that at the top of the slope that he kind of comes down pretty often, this is in Crested Butte, he said that it was just a complete sheet of ice and everybody couldn't even like catch an edge on it. And so everybody was going down on their butts as far as they could until finally kind of got a little bit slushy. So, I mean, like, you can get really, really hurt if you know what you're doing on those conditions.
Oh my gosh. Yeah. People die. Like somebody died at Winter Park this year. They kind of don't really publicize it that much, but people die under bad conditions. It's kind of scary. Yep. All right. Enough about that. I've been anybody that loves skiing, I've been apologizing to them and kind of commiserating with them to a degree. But so I would love to talk to you about the current state of private equity and DSO, the marketplace right now, because it's funny. This is a common theme. You and I talk about it, but it changes so fast. It's such a fluid marketplace that I would love to hear kind of what you're experiencing, the deal flow that you're seeing, the appetite for private equity with purchasing practices right now. We won't even get into recaps at this point, but what are you seeing as far as the appetite out there and the marketplace?
Yeah, so I feel like where it probably touches most of the folks that listen to you, I would say Interestingly enough, even though it doesn't feel like it's being publicized this way, it's as strong as ever, right?
Really?
And if you look at, the valuations that happened in 2021 in comparison to 2022, 2022 outpaced 2021 from a valuation standpoint. 2023 outpaced 2022
You're talking about
from a
a
valuation
valuation,
standpoint.
the level of sales price.
Yeah, exactly. So essentially, the enterprise value associated with the different deals that are out there. So it went up, right? So we track all of these things. Call it just in our company, 100 to 150 transactions per year, something like that. But then also across the industry, you can track it as well. And so you kind of see the different multiples that are attached, the different asset classes that are attached, all those different types of things. And since 2023, we've essentially been in stasis for practices, somewhere between, call it $1 million and $1.5 million in revenue and something like $10 million in revenue. We've been very, very normalized there. So there hasn't been any change from a valuation perspective. And it's interesting. I often get on prospectus reviews, so where we do an appraisal for a practice and kind of go through the different options that they may or may not have. And it is often that I'll hear them say, like, well, it's not like it was in 2022. I'm like, well, it's actually better, than it was in
Really?
2022 from a
Interesting.
valuation perspective. So I think that's where, most institutional capital ends up touching individual practices. It is different from a large group perspective. So whenever you're taking a large group out to market, so talk about, anything that is, call it $10 million in EBITDA and above, it is a different environment these days for sure. But for add-ons, and that's what these different individual practices or kind of small groups of practices mean to a DSO or to a group, it's as busy as ever out there.
So I wasn't going to talk about it, but I will now because you brought it up. But so these group practices, $10 million and plus, you're looking at a very specific buying pool. Not anybody can just come out and spend $70 to $100 million on a group. So you have to have deep pockets. They have to be private equity backed or sovereign fund backed or some sort of deep pocket family office type money in order to make these transactions. So what are you seeing in that segment of the marketplace?
Yeah, well, so this last year there was essentially all of the different deal making conferences. So like all these investment bankers get together. It's not a very fun group of dudes, but suffice to say, all these folks get together and they end up talking about ledges and cliffs, right?
Okay.
And there's these overhangs from a deal flow perspective that essentially have been made whenever interest rates were really, really low. So essentially, all of these different institutional investors came in. It wasn't just in dentistry, by the way. It's everywhere within private equity. They went in and they ended up having all of this money because this liquidity flooded the market, right? So whenever COVID hit, all this liquidity hit the market, and then all of these interest rates came down and just like plummeted, right? So to historic lows. And what they ended up doing is they levered up to buy all of these different assets, right? And it's from multiple standpoints. It's not like they paid more necessarily at that point, but they paid a requisite value for that asset. And really what they ended up doing for their investors is going to be buying really, really well, right? And so they bought well, and they bought all of these other add-on practices. Now, in a private equity cycle, what you need to have is you need to have liquidity for your investors at some point or another, right?
Mm-hmm.
So if let's say that there's a private equity fund that I'm an investor in, right? And I give that fund $1 million, right? By the way, I can't get into many of those investments, but let's say I'm able to give that fund $1 million. At some point or another, I'd like my $1 million back plus the returns. Right. So I mean, that's kind of a normal thing. And there's this crisis that happens whenever the interest rates go like this and the values end up kind of following those interest rates, that whenever interest rates go up, suddenly that next group can't lever enough debt in order to fully cash out that original group. So there's these things called majority and minority buys. And I know I'm kind of getting into the weeds a little bit, but majority buys is what most investors want, because that way the private equity fund can invest or can divest themselves completely. New private equity fund comes in, management stays the same in the org, all those kind of things. And there's not enough debt leverage in order to do this because the debt covenants just don't allow it, right? And so what we've seen is going to be, rather than recapitalization events happening, that people have gone and gotten more debt, which, by the way, is available, right? And you can do all of these additional add-ons. So each of these individual groups are buying other practices rather than having recapitalizations occur from a minority standpoint. So there are still, deals that are happening, but they are fewer and farther between because of the difference from an interest rate standpoint and what a majority buy means. That was a lot of industry knowledge, or a lot of just kind of like going deep. But yeah, that's kind of what we're seeing out there.
So what happens then, Kyle, with the investors and their necessity to make them liquid at a certain period of time if there is no recap event and you're just bringing on more debt?
Yep. So what happens is there's this constant push and pull from a market perspective that says, what are we willing to sell this asset for at some point, right? And so think about it if you have a house, right? And you bought this house 20 years ago for $1 million, right? And you sell, or you want to sell the house at this point. And let's say that you put it on the market for $1.5 million. But what if there aren't buyers there at $1.5 million? What if the buyers are going to be at $1.3 million?
Delist
you have to make a judgment whether you will. What'd you say?
You would probably delist it and just kind of wait out the current scenario, the current market.
There you go. We have to make a value judgment of like what you're willing to sell it for, right? And so that's kind of where people are. And there's this constant push and pull from an investor standpoint. And this is, again, all of the investors within the private equity funds that want liquidity and are putting more pressure to get these deals done. And so essentially it's these private equity funds that are playing chicken with each other, right? That are saying, hey, I bought this at this amount and I know that you want to sell this here. And I have assets on my book that I want to sell as well, but I can't sell them as high as I want to either. So everybody is just kind of like, it's a log jam. Everybody's just holding, right? And at some point or another, that log jam breaks, right? So deals start to come through. And whenever those deals start to come through, then you end up seeing liquidity in the entire market, right? Because that cliff essentially kind of breaks down.
Got it. So they basically, the private equity firm would just say, you don't get liquidated right now. Sorry. But at some point you will.
Costs. But yeah, by the way, that typically costs them a lot to do that.
Okay.
So, So like if you look at the way that these private equity funds are built, they are going to go around and get investors, pension plans, really high net worth investors, all those different types of folks. And they say, hey, we want access to your money. And you say, of course you do. Everybody does. And they say, okay, what we're going to do is we're going to give you a defined rate of return, right? And that defined rate of return might be 10, 12, 14%, right? So 14% means you can double your money in a 5-year hold, something like that. But they say you can't ask for the money back in the interim. So you can only ask for the money back whenever we are taking investments off of the table. Here's the thing. If it goes longer than that, call it 5-year hold or 7-year hold, whatever that fund structure is, then suddenly that interest rate levers up. So they now have to pay more to their investors, which means the fund managers don't do as well. Right. So it has to be a value judgment that really makes sense. Right. So if they can't sell it for what they want to, they understand that they are taking a risk by doing that. And they want these additional add-ons to take place because those additional add-ons essentially continue to increase the value of that business because the asset base is bigger. Right. But they're trying to do that to make sure they outpace what the leverage is for their investors. It's kind of a catch-22 for them a little bit.
So there's no money exchanging at this point, right? So at a 3-year period when you're expecting to liquidate your initial $1 million investment and there's no appropriate buyer, so you get a higher interest rate. So you get, for the first 3 years, you get 10%, and for all subsequent years after that, you're getting a 14 or something like that?
Yep.
Okay. Interesting.
Yep.
Interesting.
Yeah. So, and whenever you think about, I remember whenever we had the financial crisis, everybody was so ticked at these hedge fund managers. They were getting these huge bonuses, right? Those huge bonuses are tied to the risk that they're willing to take, and so if they're taking outsized risk, which means, hey, this is a very expensive investor who's coming in, and the interest rate that I'm paying is going to be higher. They might be willing to, take this bigger risk, meaning bigger returns for your folks. You develop a bigger fund, and in return, you get these really, really big, chunky returns whenever you end up selling those assets. But they just haven't figured out the right way to sell them quite yet. A lot of those things, what we've seen at this point, are minority deals specifically within dentistry.
Got it. Okay, that's very interesting. That actually enlightens me to a certain degree. I'm learning stuff here. So when people out there are saying, yes, it's frothy out there for single practices or small groups, they're being brought into these private equity backed DSOs. That market is still very strong, but when we're talking about DSOs looking to recap, what's happening is they're having to bring on more debt because it's not the right time to sell because there's not an appropriate buyer. So recaps in some people's eyes don't exist and are over forever, right? So that's the narrative that you hear all the time because they see this scenario unfolding in front of their own eyes, and they see three, large-ish, mid-sized to large DSOs that are trying to recap, unable to recap, so they brought on more debt. So people are assuming that recaps will never happen again.
Yeah, I mean, again, that's just not the way that a consolidation wave happens. And again, let's take it outside of dentistry, right? Because that's where all of us live our lives, right? Is in the dental world. And if you look at, the hundreds of industries that have gone through a consolidation wave or that are currently going through a consolidation wave, transactions don't suddenly just go away, right? Mm-hmm. Unless the industry is dead, right? And so horse carriages don't have recapitalization events, right? So I mean, but if you look at auto parts manufacturing companies, they definitely do, and so I mean, there's a lot of M&A that happens within that world, even though it's primarily consolidated. And so once you get to a consolidation, then it's going to be kind of hovering around that tick mark. But I mean, there's still a lot of work to do from a consolidation wave in dentistry that is still yet to come. And that kind of necessitates additional types of equity coming in. So both private equity, family funds, eventually we will definitely see much more public investment as well. So, I mean, I think that's an inevitability as well. Okay. And that could be good or could be not good, kind of depending on how you end up looking at it. But suffice to say, this is not the first time within healthcare, right, that this has happened. And it's definitely not going to be the last either. And these types of consolidations happen because of market factors, right? So I mean, it has talking about how something is just over and done with. It's a fallacy. It just show me a comp where that has happened in another industry that is not a dying industry.
Yep. Okay, that's great. So what market conditions are we hoping for if we're a mid-sized to large DSOs in order to get those recaps done? Or people that have been purchased and they own either shares in Holdco or they're JV, and they're hoping that that percentage of their ownership or the shares that they have in Holdco experience this recap that everybody's hoping for, a minimum of 3x or whatever. What market conditions are we looking for?
I mean, honestly, the market conditions that we currently have are completely great. We have to figure out what it was, right? And so the fact that 21 and 2022, with all of the liquidity and the low interest rates happened, it's just a function of time, right? So do we hasten up the time by having lower interest rates? For sure, because everybody's value judgment is going to change, right? Mm-hmm. So you end up saying, okay, well, instead of having this $1 million house that was worth $1.3 million in this environment, if it's now worth, call it 1.4, 1.45, okay, maybe it's worthwhile for me to go ahead and take this amount off of the table, right? Because again, they have investors that they want to please as well. And by the way, they can't go out and raise more funds until they get liquidity from the existing funds, right? And so all these different private equity funds that want to raise that next round of funds are not able to do so until they end up getting liquidity for their investors. Because who's willing to reinvest in something that they haven't gotten liquidity from yet, know?
So if we're going to draw a parallel, just going back to this analogy of a house, right? So you have this house at a certain interest rate. It's priced at, and the all of the comps and everything that's happening within that particular region or that particular housing market, you're going to get a price that you want to sell your house for. It's not going because interest rates are at a certain percentage, right? So it's expensive to borrow money for this particular house. So as interest rates rise, the sales decline, right? Because people are trying to wait out the market. So if interest rates all of a sudden say there's, I don't know, in later on this summer, we have a new Fed chair, and interest rates suddenly drop by a couple points. I don't think it's going to happen, but by a couple points immediately. So does that decrease the value of the asset or increase the value of the asset?
Increase. It's an inverse relationship.
Okay, so it increases the value of the asset because money is cheaper to buy, and people, you have to look at it like from my amateurish view, you have to look at it as a monthly payment, right? So you can borrow more money for less dollars or a less of an interest rate, so you can afford more of a house.
Yep.
Right. So
yep.
If interest rates decrease, and we're going back to now private equity and their appetite for purchasing, are those recaps more likely to happen, or are they less likely to happen because of the price of the assets increasing?
Yeah, I would say way more. And it's because the expectations that you've set for the investors, the existing investors within that fund, right? They have a certain expectation for what they want their returns to be. Once you can get that liquidity and those returns for that investor, there'll be a strike price, And so if you look at the interesting thing about it is going to be, if we take that same house analogy and essentially say, well, I don't want to sell anything less than 1.5 million, right? Something like that. The types of deals that we're seeing out there is, instead of somebody paying $1.5 million for a house, they'll pay $500,000 for a third of it. Right. And so that's the types of deals that we're ended up seeing right now. So they're still getting the same type of value that they would have gotten, call it in 21, 22, 23, 24. They're just not getting as much liquidity because they can't leverage much debt against it.
Got it. Okay. That makes a whole lot of sense. So what happens then when these interest rates decrease for the one-off and two-off seller? Back to the mom and pop shop, or I mean, even if it's a larger practice that's very attractive to a DSO, but it's a single off, are they going to get more money for that practice, or is it not that parallel to the housing market?
It's not, and so the reason is that if you have a practice that does somewhere under, call it $2.5 million in EBITDA, there's kind of a hard ceiling there in terms of what you can get for that business.
Is it? What's the range of multiple?
Yeah. So, I mean, you're looking at something like, an 8 to an 8.5 times for like a really, really good asset. And there's a really specific reason for this. That really specific reason is the amount that you can lever against these different assets from a debt perspective is essentially it's managed by the bank, who is the funding mechanism of that private equity fund. Mm-hmm. And they are not going to allow you to take out more than 3.5 turns of EBITDA for that asset. And so really what it comes down to is, how much money have you saved up from it as a DSO after your interest payments, all that kind of stuff, that you can reinvest into these practices. Mm-hmm. And typically they are not going to spend a half year saving up in order to get somebody a 9 or a 9.5x. It just doesn't happen. It's better for them to go out and buy a whole bunch of different assets at 6, 7s, maybe an 8 here and there, because it delevers their position. So if that entire group was bought at a 12 times and you go out and buy a whole bunch of other assets at a 6 times, what you've done is you've essentially kind of cost averaged your buy at something like an 8 or a 9, right? Mm-hmm. If you buy too many other things at 8s and 9s, you haven't cost averaged yourself down low enough for it to make sense.
Yeah. Okay. That makes sense. So, yeah, interesting. Above that $2.5 million threshold, then we're looking at higher multiples, and to what ceiling and what tranche of money? To 2.5 to $5 million in EBITDA, you're looking at maybe a 9?
Yeah, so it's kind of interesting. So it depends on the type of asset that you have. And whenever I'm saying this, that it matters a lot how much has been built out, right? So in order to get a higher multiple, you really need an operating business that doesn't look duct taped together, right? Mm-hmm. If it feels like it's duct taped together, you put 10 practices together, and those 10 practices essentially make up even $10 million in EBITDA. If it feels like there's not enough cohesiveness and not enough infrastructure and not enough things that bind all of the practices together, then you're probably still capped out right around the same range, right?
Mm-hmm.
Because they know that stuff still needs to be built, right?
Yeah.
Most of the time, that is also not going to be a DSO who's going to be buying it at that point. That is going to be used as a platform. And that platform essentially needs all that infrastructure being built out, because in order to put additional practices with it, you need, the head of M&A, you need a marketing chief, you need somebody from an ops perspective that essentially standardizes across the org. You need all that other stuff to make it feel like a really substantial business. So that way somebody who's from a private equity fund can say, okay, this C-suite is well taken care of, those kind of things. So it's harder to get the types of buyers from a financial standpoint to be interested if you haven't built that out. Inversely, it's way easier for a type of buyer that already has a DSO platform to see the forest through the trees whenever you haven't built that stuff out yet. So it's kind of 6 of one, half dozen of the other. But I mean, you're talking about really, really substantial practices, once you've gotten to call it $10 million in a full org and all that kind of stuff.
Yeah. Yeah. And you get paid commensurately high for that, that type of thing. Yeah. I mean, I'm very familiar with the whole concept here. You have a bunch of friends that put, 10, 12 practices together. And you go to market at the same time, and they're going to look at you like 10 or 12 individual practices, not as 10 to 12 that are cohesively run with one C-suite, centralized billing, one accountant, one level of operations, same everything. So that is.
Well, and really kind of what we're talking about here is like quality of asset, really. And you can extrapolate this down or up as high as you want to, right? So if you say that I have $1 million practice with one doctor, one hygienist, 2 assistants, and 2 folks in the front office operating out of 4 operatories, that is one quality of asset. And the way that you can kind of garner additional quality on that asset is going to be, one, hopefully increase the revenue, right? Thing 2 is going to be build operational efficiencies and systems, right? So really systems is where all of the value ends up coming from in a way, right?
Yeah.
So whether that's, getting patients in or making sure that they're effectively pushed through the system or making sure they continue on from a hygiene recall perspective, whatever those different systems are, or increase capacity, right? And so as revenue grows, you need to increase capacity, so quality of asset grows. And then suddenly you're like, well, hey, maybe I need to bring on this other doctor, right? And this other doctor now essentially diversifies your provider risk, because that's one of the things that you have whenever you're a single owner producer, right? Whenever you're a single owner producer, what happens? We get asked this by DSOs all the time. What happens if this person gets hit by a bus?
Yeah, it's key man risk. Yeah.
There you go. Yep. And so I've often said that a person who has a $2 million practice where they're the only producer, that is the riskiest place to be in all of dentistry, right? And it's because if something happens to you, your asset is toast. So the more providers that you can get in, the more people, the more infrastructure that you can put in, the better. And again, that scales up over the course of time, whether that's multi-locations, whether that's going to be, an operating system, whether it's a tech stack that you end up putting in. There's all of these different things that improve the quality of the asset, and values grow commensurately with that.
I'm just going to this is a one-off question, but we work with a lot of kind of spouse couples that are both involved with the business. Would that be the same key man risk if they had a high producing practice and the only producers in the practice were the husband and the wife?
Yeah. It is looked at differently. And whether fair or not, it is going to be looked at differently than
with more caution,
unrelated parties.
Okay. Mm-hmm.
That are going to be high producers within a business. And we do get questions about that. It's like it's almost like, okay, you might have diversified some of the provider risk, but there's this marital risk that is out there as well, right?
Yeah,
because
for sure.
Half of marriages end in divorce, and that's not a stat that I want to have happen, but it is, right? It's out there, and so they would still consider that kind of a riskier proposition than 2 unrelated parties. By the way, I don't know if I buy that, just so I say that out loud. But we do end up getting the question, and we do end up seeing it reflected in multiples.
In partnership sales, just in general, I mean, marriages is one risk, but partnerships have the same failure rate as marriages do, sometimes a little bit higher. So in partnership selling, do they take that into account as well?
Well, so the data that we have seen out there, specifically within dentistry, is that partnerships have about an 80% success rate over a 10-year time horizon.
Oh, that's pretty good. Better than I thought.
That's pretty good, actually. Yep, exactly. So, and if you look at that in terms of associates, the associates have about the inverse rate of success. So it's about a 20% success rate over a 5-year time horizon. And that's why I said I don't necessarily buy this, because we don't end up doing a lot of transactions where husband and wife end up getting divorced and everything blows up, right? Lots of times there's still some sort of working relationship there, because that's still a very important asset to both parties,
Yeah.
And so whether only one person keeps it or not is different, but we still see an ongoing asset. We don't see, it crumbling very often based on that. So again, it's not something that I would necessarily agree with, but we do end up seeing a difference there. And interestingly enough, we don't see an or a difference from a valuation perspective whenever it comes to a partnership. If you have two 50-50 unrelated partners, they consider that diversified.
Okay. In your business right now, Kyle, what is the percentage of larger practices that are that $2.5 million kind of threshold and above versus smaller practices that are, say, I guess you could say top line revenue less than $2 million? What are you seeing?
Yeah. So I think right now we have something like 140 or 150 practices that are on the market, of which I would say, probably about 100 of them are going to be on the larger side, so $2.5 million and above. But that's also going to be a function of the type of practices we typically work with, right? And the types of tools that are in our toolkit, just because there are more things that you can do whenever you have a larger practice. And whether that means bringing on, call it private equity investor, whether it's a DSO or a partnership program, or going to be selling parts and pieces to different doctors or restricted stock units. I mean, there's all sorts of different things that you can do whenever you have a larger asset that you just don't have as many tools in your tool belt whenever it's going to be smaller.
Yeah. Okay. That's cool. So, let's do a little bit of myth busting here. So a lot of people are like, why would I ever sell in a doctor to doctor transaction? When I know that I can get a significantly higher valuation for my practice. Let's talk about what, the good, the bad, and the ugly of selling to a private equity backed DSO. And then the flip side, what are the benefits of selling in a doctor to doctor transaction, even though we all know that the valuation is going to be less?
Yep. Okay. Well, still probably 15 to 20% of our transactions on a year-to-year basis are still individual sales,
Okay.
right? And if I look at the benefits of selling it to an individual, I would say that a lot of the benefits end up coming with like the feeling of, right? So typically it's a doctor who bought their practice from somebody, right? And that somebody was kind of instrumental in helping that person launch their career, all that kind of stuff. And they like the feeling of being able to kind of pass it on to the next generation, right?
Mm-hmm.
And I think that feeling kind of comes with a price, just like you talked about, right? And that price is going to be, okay, you can't get as much for it if you end up doing it that way. But I do think that there's some benefits. I would say that, having somebody come on board, it prevents loneliness, which is kind of it's an epidemic within dentistry, right? And so whenever you have multiple providers, those kind of things, it can change your outlook, and it might end up helping grow the practice as well. We do often see that whenever there's that next provider in, oftentimes the practice ends up growing for a variety of reasons, and kind of getting some more youth, vigor, those kind of things, I think it can be a good thing as well. But again, I think a lot of the reasons that you end up doing that is going to be more psychological or soft type of stuff more than anything else. And look, out of the 25 practices that I owned, I think I sold a total of 16 of them to individuals, right? And there was, I like that. And I still talk with a lot of those doctors, right? They still own those practices. So I enjoyed that process. Okay, now, whenever we think about selling it to a DSO, okay, so obviously you're going to get a higher value, right? There's really just no way around it if you end up looking at the income stream that you can get from your dental practice in comparison to the value that you can get upfront, the de-risking that you end up doing, and then also the ability to kind of go along on the private equity cycle, whether it's a 3 or a 5 or a 6 year time horizon before you end up getting liquidity. You will get liquidity there. And so
unless the DSO fails, which has happened to people, and they lose their retained 30 or 40% or whatever. I've heard of that. Yeah.
I mean, again, I think about scale and scope a lot whenever I think about these things. It's like, okay, so show me the ones that have failed, right? And then show me what the outcome for those doctors ended up being, right? Mm-hmm. And so if I look at the ones that have failed, right? So I mean, like you look at Small Smiles, which was a Medicaid practice group out of Pueblo, Colorado, that ended up kind of getting about 200 locations across the U.S.
Wow.
They ended up having severe Medicaid fraud back in the 1990s. They had a 60 Minutes episode about them.
Wow.
And so
that'll do it. Yeah.
Yeah, and everything blew up, right? Everything blew up. And if you look at the way that blew up, who that hurt was the bank and the private equity firm. The doctors essentially bought all of those practices back for pennies on the dollar, and many DSOs sprouted out from that as well. If you look at, Floss down in Texas, that was going to be rampant fraud. It wasn't private equity backed, but it was rampant fraud from the owner. And if you look at the way that those doctors got out of it, a lot of those were joint ventures. A lot of them did have holdco stock, all that kind of stuff. They bought back all their practices. And by the way, that was one of the seed groups for MB2. There's a whole bunch of those practices that are now within MB2.
Interesting.
And so the doctors did not get harmed there. I'm sure it was annoying. I'm sure they didn't like it,
Yeah.
So if you look at Orthodontic Centers of America, right? You look at those, and the amount of doctors that ended up kind of creating groups out of that was unbelievable, you know? And so really, whenever it comes down to it, there's only one person, or there's only one type of group that can care for patients, and that's going to be the doctors. So if things really, really go bad, typically the doctors end up getting to buy the assets back at pennies, and you don't see it very often, right? So I mean, I've got, a handful of comps out of 1,000 transactions that have occurred, and so the success rate is very, very similar to dentistry in general. That banks like to lend money to dentists because there's a high rate of return, right? Mm-hmm. It's the exact same thing within the DSO world as well.
Got it. Okay, so back to the reality of selling to a DSO, you got to stay, right? So one of the benefits of selling in a private transaction is if you wanted to, you can sell and walk. Depending on the terms of the deal.
And I'll also say depending on the size of the business as well. That definitely matters there as well. Okay. The larger the business that you have, the chances that even in a private transaction you can just walk is lower as well.
Okay.
Yeah.
And so with a DSO, you give up some autonomy, right? Depending on the DSO. Like there's DSOs that are completely hands off. They only buy like very, very blue chip practices, and they say, keep on doing what you're doing. The reason that we bought you in the first place is because you're a good operator, and we're not gonna change anything. But they're also, right, Kyle, gonna have some guardrails in place where they're gonna expect you to grow at a certain clip. What is that typically?
Yeah. Okay. So it's kind of funny. We're talking about these different continuums. I think about like private buyers and DSOs very similarly with this, and I'll kind of talk about those guardrails. But if you bring on a doctor who is going to be a partner with you, there is a certain amount of expectation that you have for them, right? And they're going to have a certain amount of expectation of you as well as the existing owner.
For sure.
And there's a wide variety of different folks that are out there, and the different kind of skill sets, all that kind of stuff. Some people are just producers, right? Some people are going to be able to be helpful from an HR perspective, all those different types of things. So the exact same thing exists on the DSO side, right? So there's going to be different people or different groups that are going to be more hands off in general, right? There's going to be different folks that end up, or different groups that have a call it a menu of options that you can choose from in terms of the different services that you have. And there's different groups that are going to be coming in with much more of a stronger touch because they have a playbook and their playbook has worked, right? And so if I look at the goal of that DSO, no matter who they are, the goal is going to be, we're going to buy you at this level, but over the course of time, we don't want to have felt like we paid all of that for this business. So one of the ways they do that is by growing the business. And the growing the business can be top line revenue. It could also be EBITDA margin as well. And kind of depending on the type of group you end up going with, they're going to have different levers. So if it's going to be a group that's going to be more forceful, as a for instance, they're probably going to be better at driving profitability, right? Yeah. Just in general. And the reason being is they have this playbook. It's worked for them in the past. They're probably buying assets. They're going to be a little bit underperforming, right? Those kind of things. And they're going to be turning them around. If it's going to be more of a hands-off group, well, they don't really have that as part of their investment thesis. Really what they have is going to be, okay, we're going to be working with a type of provider that is exceptional at growing their own practice. And then we're just going to be along for the ride as it's growing. But they need that lever to be true because otherwise they've just bought this asset. And then all the arbitrage they get is going to be how much they bought it for and how much they're selling it for. There's nothing in the middle. And that's probably not the best way to run a business either. You don't want to have just something in stasis.
Yeah. And the terms and there has to be some sort of a mechanism in place that doesn't demotivate a seller or a seller rather. Once they sell and they get 60% cash, which is more than they thought that they could get for the whole practice, they take their foot off the gas and their 40% is kind of at risk for deteriorating as far as value goes. And they're less of a valuable asset to the buyer.
Yeah. Well, it's also, so in a way, all of these different structural components of the deal, all of them are there to make the deal sticky. And that may be sticky for the provider to stay on board or sticky to just make sure that the asset doesn't, fall into the tank. Every once in a while, we end up getting these things called divestitures. And divestitures are going to be this DSO bought this practice and it didn't work, right? And it doesn't happen all the time, but every once in a while we run into one. Where we're doing one right now that happens to be a 4-practice group down in Texas. And that 4-practice group originally, whenever they were bought, was doing about $8 million in revenue. And now at this point, they're doing about $5.5 million in revenue.
That hurts.
Now, everybody can point fingers and say, okay, this is this fault or this fault, all those kind of things. But long story short, it's not an asset that the buyer would have wanted to see this happen to. That is a really, really bad investment thesis. They shouldn't have bought this asset is really what it comes down to. The doctor made out just fine, right, on it because they ended up selling, call it at the height of the business. And if this was going to happen regardless, well, they actually did okay. The DSO is not very happy about this outcome, and understandably so. And so now it's our job to go out there and try to figure out, okay, well, if we take them away from this DSO and then put them somewhere else, does someone else help them? Or do we end up needing to kind of take this asset apart and say, okay, there's 4 different practices here. Maybe individuals need to be owners of these practices to help them out, right? And so anyway, these things do happen. And the goal of the DSO is to say, we don't want them to happen often.
Yeah. So much to talk about, dude. That was a good one, though. That was a good one. We went all over the place, but as always, these are kind of questions that are top of mind for me, and I'm seeing so much change so fast. It's always great to kind of get your take because you have your finger on the pulse. You're seeing, multiple deals all day, every day. So I appreciate your insights. We're going to keep on doing these as often as you're available.
Awesome, man. It was my pleasure as always.
All right, buddy. So, ladies and gentlemen, Kyle Francis, the founder of Professional Transition Strategies.
Look at you. There we go.
Got it.